Should we blame the recent stock market crash on the weather? Well, I think so, and Ed Yardeni hears so. It sounds kind of outlandish. How could the weather impact the stock market, especially the drawdowns we saw in the S&P 500 hitting almost correction territory and the NASDAQ hitting correction territory? Well, I think so, and Ed Yardeni thinks so, and here's why. Last month, we had Hurricane Beryl hit Texas, and that pretty much affected some layoffs, temporary layoffs, and that factored into the July jobs and unemployment report number, where it showed lower job growth than expected at 114,000 jobs, and it ticked up the unemployment rate to 4.3%, triggering that Sahm recession rule that a lot of investors and traders were afraid of. However, Claudia Sahm, the creator of that same Sahm recession rule, actually went on a few news outlets and wrote an op-ed pretty much saying, although her Sahm recession rule triggered and although we're increasing likelihood towards a recession, we're not necessarily there yet. The increase in unemployment rate, she's saying, is more to an increase in labor supply from immigration and not necessarily a decrease in labor demand. And that pretty much everything since the pandemic got warped in that regard. So the fact that it's an increase in labor supply and not an increase in labor demand, ticking up that unemployment rate by 0.5% higher than the 12-month low. The Sahm rule is the 3-month average has to be 0.5% higher than the 12-month low. And although it triggered, she thinks that in this case, it's an exception, that it's mostly just due to labor supply and based on the current environment and the unusual economy after the pandemic. And this combined with today's job report, well, it was the jobless claims report, and that number came out lower than expected, which is good news. So the amount of Americans that are filing for unemployment went down for the week, down to 233,000 compared to 250,000 last week and 240,000 expected. This is causing the stock market to really surge today. Yesterday, we had some fear in the market. The market started off well, but it sold off at the end, almost a sell the rip event, as there was a poor treasury bond auction and not that great of demand for our treasury bonds. So that kind of spooked the markets yesterday. But this good jobless claims report today showing that there's a less amount of Americans filing for unemployment claims for this week is making investors think maybe we're not in a recession after all. Maybe, in fact, that July jobs and unemployment report number that was worse than expected and triggering that Sahm recession rule with that 4.3% unemployment rate could have been a one-off due to weather-related factors like Hurricane Beryl. I kind of think so, especially considering this better than expected jobless claims report for the week. So that's something to keep in mind. It makes me a little bit optimistic that maybe this market rally has more room to run. Also, Jamie Dimon had an interview yesterday pretty much saying that the American economy is alive and well. He's pretty optimistic in terms of a lot of things with the economy. So that's something else to keep in mind. But look, I'm pretty optimistic. The market could certainly trade sideways, as I said yesterday, for the next couple months. But I think October and especially November should be good returns for the stock market. I think small cap stocks will be better than large cap stocks in this environment. That doesn't necessarily mean they'll do well, but I think small cap stocks will fare better in a sideways stock market than large cap stocks. That's just my opinion. Let's see how everything goes. But yes, I certainly think that the weather and Hurricane Beryl could have had something to do with the stock market crash because investors were fearing a recession due to the July jobs and unemployment report number, which was artificially and temporarily low, in my opinion.